Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. I am sorry. I hope this may not take as long as recent weeks, but please be prepared. This may take some time, I'm afraid. Firstly, I wish to set out the market's overall picture. The reason this may take some time is there is no simple solution here for what is a very complex problem. The bear channel for the February to June action, which is highlighted on my daily chart in bright red, had been the most significant pattern this year. 7 weeks ago, the market broke up through the upper bear channel line and confirmed the break higher by the end of that week. It did this by closing over a number of important resistances, notably the 50% Fibonacci, absolute Fibonacci line at 682. The move up over this 50% absolute Fibonacci line was intrinsically important, but it was also important in another sense, as it was the gateway to the congestion band from March and April between 682 to 721, within which sits the January 2021 high at 693 and the old October 2013 high at 721. 5 weeks ago, prices followed on even higher by utilizing the medium moving average, currently 673, as a base for an attempt up into another congestion band dating from December last year through to February this year, between about the March 2014 high at 725 up to a lesser Fibonacci line at 799, and containing within it the January 22 low at 739 and the May 2014 high at 744. The market made up into this congestion band, pushing up over the March 2014 high and even over the one piece of resistance coming down at that time that any market would usually have trouble in overcoming, and that's the slowly declining long moving average, currently at 724. Prices punched through the long moving average on two separate occasions in June, but did not close over it. Okay, so this is where I reprised my discussion point from 4 weeks ago, not only to discuss it as a point, but later to bring it into this week's action. Okay, so I said 4 weeks ago, and I quote, "Wherever I have named a specific level as one of the most stunningly accurate pieces of technical analysis I've done in a while, or else someone was taking the mickey." You see, for a few weeks now, I've been talking here about bear channel highlighted in bright red that I mentioned earlier. Last week, so that is now 4 weeks ago, I even finessed the point further, 5 weeks ago actually, so I even finessed the point further by specifically highlighting a topside level. This was what I said, and I quote, "Thus, a primary target X would be in the 770 area, only a little above where we have reached, but the secondary target X1 will be a lot higher up in the 855 area, and there's quite some congestion overhead, and one important downtrend, the March 22 to date downtrend, currently at 799. This is the one based on the ultimate high of this market. We'll have to see if the market can achieve target X first." End of quote. Well, as you can see on the daily chart, the high in late June, after this original commentary, was in the 770 area, specifically at 770 and a quarter. Thus target X was reached, and the market immediately turned and fell away. I do not believe that to have been a coincidence. I suspect it was another technical analyst who also came to the same conclusions I did and acted upon them. Or alternatively, you could believe there was just the market taking the mickey. In any case, I was grateful to see target X achieved, and then to see prices fall away, justifying it. Since then, we moved back below all the previous resistances that first became supports that have now again become resistances. It fell down to the significant neckline extension, currently at 649. And that's of the small October 2020 to November 2022 head and shoulders top, which is highlighted in purple on my daily chart. This neckline had a fairly wide congestion area clustered around it, formed from late April to mid-July, between about 609 to 679. This congestion lasted for about 2 weeks at the start of July, supplying the market with enough ammunition for prices had another attempt higher 2 weeks ago, and also again last week. That rally from the neckline and also over all 4 moving averages moved all the way up to the 770 target X area again, exceeding it before the phantom technical analyst out there, or Mickey Taker, take your pick, chose to cap it last week as a new high, one not seen since February, and with a 3-day bearish evening star pattern. That's important, remember that, it's a 3-day bearish evening star pattern at the top. We also came the closest to the significant March 22 to date downtrend, currently at 799. As a side note, the secondary hard to reach target X1 for the bear channel is still there at 855 and will stay there for the moment. Okay, so the move back down with the interesting 3-day bearish evening star pattern at the top sort of dropped down through all the supports that became resistances, that became supports, and are now once again resistances. In the process, the market decimated one idea I had for the potential future of this market. The idea I laid out 6 weeks ago of this being a possible descending scallop pattern, and at the same time has seemingly supported another pattern I'd earlier laid out as an idea and put forward one, maybe up to 3 others. So I'm laying aside, retiring for now, the idea of the market having a descending scallop pattern. Now, I may resurrect this idea when I look at the longer term charts, but for now there are closer patterns that will have a more considerable impact in the near term, and those I'd like to discuss. Okay, so last week I floated the potential developments on the actions since late May to mid-July being possible bullish Andrews and shift pitchforks. I highlighted both. But this week's actions has quickly dealt a mortal blow to the idea of a bullish Andrews pitchfork, and I've quickly retired it already this week. This has left us with the bullish shift pitchfork, which is highlighted in bright green. So far, this pattern has worked. So far, with a halt last week at the upper time, currently at 804, and a seemingly halt this week just above the lower time, and that's currently at 642. It has also seen the generation of other potential patterns. The first I'd like to discuss is an unusual one. It is the one that immediately springs to mind when looking at the market, but looks in the wrong place, and that is to see the whole of the late May to date action as a possible double top with a neckline at the same purple neckline of the small but influential October-November 2020 Head and Shoulders top. That's currently at, say, 649. The second one is a little more rare, and it is to regard the same action since late May as a possible rising three valleys pattern with a base on the lower time in bright green. Now this is synonymous with the late May to day uptrend, currently at 642. Aesthetically, this second pattern looks more appealing, but it also has its issues. I wish for the moment to just lodge these ideas in your mind before expanding upon them further, or retiring them completely, and maybe bringing myself back to the descending scallop pattern idea again. However, I do note that the week after next, the neckline and the lower time cross over, which should provide an interesting point to watch, and by late October, the lower time and the downtrend from March 22 also cross over. Chicago corn. Back in early to mid-June, we saw a remarkable recovery that carried on into the third full week of June. Prices punched up through the older congestion at 548 to 556 and at 561 to 567, like they were not even there, along with some more recent congestion from early May between about 580 to 600. This congestion, as I said 7 weeks ago, and I quote, apart from being recent, is also not that strong, and it would not be surprising to see a move higher towards the wide band of stratified congestion from February through to April between 610 and 640, end of quote. In addition to the congestions, the market also punched up through the short medium moving average, currently at 529. Then also the medium moving average, currently 564, as well as the late February to date downtrend, currently at 582. All these congestions, along with the 610 to 640 band, have slowed and eventually turned the market back down, without the need of relying on the capping action of the descending long moving average further up, which is currently at 614. Now, the pullback lower at the end of June and into July had been similarly remarkable. I even speculated on there being a possibility of a descending scallop pattern 6 weeks ago. Interestingly, this seems to be on the cards, as in early to middle of July we saw the market hesitate before turning back upwards. I commented on this 5 weeks ago thus, and I quote, At the moment the market is being held up by the combination of 2014 high and a 61.8% absolute Fibonacci line at 525. This is not enough, nor is the October 2021 low at 516, nor the lesser Fibonacci line at 506. Only when we may see prices down within the congestion between 486 to 498 that contains the 2021 low at 498, only then can we start looking at this potential descending scallop pattern as having been formed. End of quote. Well, prices did fall down to the congestion between 486 to 498, and 3 weeks ago the market formed a pipe bottom and shot back up again, penetrating all the resistances, once again halting temporarily at the July 2013 high at 563.5 with a pipe top, before on Monday last week prices once again moved higher, though only as far as the descending medium moving average, currently at 571, before heading back down again below the congestion between 548 to 567 and below the recent 50% Fibonacci line at 549, gapping below the combined 2014 high and 61.8% absolute Fibonacci line at 525, also below the October 2021 high at 516, and down to where we are now at the 490 to 498 congestion around the 2021 low at 498. Last week I said, and I quote, Looking at this action, there is no way that this action since late June could be seen as a descending scallop pattern, no matter how much I optimize it. Once again, for a second week, I'm going to take a short step back and wait and see what new pattern will develop here. End of quote. Well, I say this honestly, upon reflection, the action since late June could indeed be seen as a possible descending scallop pattern, and we may be about to see the completion of that pattern with the possibility of its resultant move. However, to be ever cautious, there is not an easy pattern here, and there may be something else available. And in this, I am looking at the action since mid-May to possibly be a descending wedge pattern, currently 468 to 554. This pattern is not complete yet, and it has a girth that I am not comfortable with given its duration. But it also may be there, so watch to see what happens at this 490 to 498 congestion. You never know, maybe they will both work together at the same time. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.